Did you know that the first commercial Bitcoin transaction was for pizza? On May 22, 2010, a man in Florida paid 10,000 Bitcoins for 2 pizzas. That's worth more than $190 million to day one. How crazy is that? But that's not the only surprising thing about cryptocurrencies. In today's video, I'm going to compare and contrast 2 of the most popular and controversial types of investments, stocks and cryptocurrencies. Which one is more volatile and risky in 2024? And which one should you invest in? Let's find out. First, let me explain the main differences between stocks and cryptocurrencies. Stocks are shares of ownership in a company. When you buy a stock, you become a part owner of that company, and you have a claim on its assets and profits. Stocks are backed by the company's performance and reputation, and they are regulated by laws and authorities that protect investors' rights and interests. Cryptocurrencies, on the other hand, are digital assets that can be created and stored electronically using cryptography and blockchain technology. When you buy a cryptocurrency, you own a piece of code that represents a unit of value. Cryptocurrencies are not backed by any physical or legal entity, and they are not regulated by any central authority or institution. Both stocks and cryptocurrencies have been affected by various trends and events in the past few years, such as the COVID-19 pandemic, the rise of meme stocks and coins, and the increasing adoption of blockchain technology by governments and corporations. These factors have influenced the demand and supply, the sentiment and perception, and the innovation and competition of both markets. Now let's compare and contrast the volatility and risk of stocks and cryptocurrencies using data and examples from the web search results. Volatility is a measure of how much the price of an asset changes over time. Risk is a measure of how likely you are to lose money on an investment. Cryptocurrencies are generally more volatile than stocks, with prices that can fluctuate significantly over short periods of time. For example, Bitcoin, the most popular and valuable cryptocurrency, reached an all-time high of over $60,000 in April 2021, but then dropped to below $30,000 in June 2021, losing more than 50% of its value in 2 months. Ethereum, the second largest cryptocurrency, also experienced a similar roller coaster ride, reaching over $4,000 in May 2021, but then falling to below $2,000 in June 2021, losing more than 50% of its value in 1 month. The high volatility of cryptocurrencies can be attributed to factors such as demand and supply, speculation, hacking, and regulatory uncertainty. Cryptocurrencies are driven by the forces of supply and demand, which can change rapidly and unpredictably due to the limited supply, the high demand, and the influence of whales, who are large holders of cryptocurrencies that can move the market with their trades. Cryptocurrencies are also subject to speculation, which is the act of buying and selling based on expectations of future price movements, rather than on the intrinsic value of the asset. Speculation can create bubbles and crashes as investors chase after the next big thing or panic sell when the market turns sour. Cryptocurrencies are also vulnerable to hacking, which is the act of breaking into a system or network and stealing or manipulating data or funds. Hacking can cause security breaches, data leaks, and thefts, which can erode the trust and confidence of investors and users. Cryptocurrencies are also affected by regulatory uncertainty, which is the lack of clarity and consistency in the rules and regulations that govern the crypto market. Regulatory uncertainty can create confusion, fear, and doubt among investors and users as they face the risk of legal actions, bans, or restrictions from governments and authorities. Stocks, on the other hand, are typically more stable than cryptocurrencies, but they can also experience sudden drops or spikes due to market sentiment, earnings reports, news events, and geopolitical tensions. For example, the S&P 500, the most widely followed index of the U.S. stock market, reached an all-time high of over 4,500 in August 2021, but then dropped to below 4,300 in September 2021, losing more than 5% of its value in 1 month. The Dow Jones Industrial Average, another major index of the U.S. stock market, also followed a similar pattern, reaching over 35,000 in August 2021, but then falling to below 34,000 in September 2021, losing more than 3% of its value in 1 month. The volatility of stocks can be attributed to factors such as market sentiment, earnings reports, news events, and geopolitical tensions. Market sentiment is the overall attitude and feeling of investors and traders towards the stock market. Market sentiment can be influenced by various psychological and emotional factors such as fear, greed, optimism, pessimism, herd mentality, and confirmation bias. Market sentiment can create trends and cycles as investors and traders buy and sell based on their expectations and emotions, rather than on the fundamentals of the companies. Earnings reports are the financial statements that companies release periodically to show their performance and profitability. Earnings reports can affect the stock prices of the companies as investors and traders react to the results and compare them to their expectations and forecasts. Earnings reports can create surprises and disappointments as companies beat or miss the estimates and projections of analysts and experts. News events are the occurrences and developments that happen in the world that can affect the stock market. News events can be positive or negative, and they can be related to various topics such as politics, economics, business, technology, science, health, environment, and culture. News events can create opportunities and challenges as investors and traders adjust their strategies and positions based on the new information and implications. Both stocks and cryptocurrencies involve risk, but the nature and degree of risk may vary depending on the type and quality of the investment. Stocks are subject to market risk, company risk, and inflation risk, but they may also offer dividends, voting rights, and legal protection. Market risk is the risk of losing money due to the overall decline of the stock market. Market risk can be caused by various factors such as recessions, crises, or shocks. Market risk can be reduced by diversifying the portfolio across different sectors, industries, and regions. Company risk is the risk of losing money due to the poor performance or failure of a specific company. Company risk can be caused by various factors such as competition, innovation, regulation, or scandal. Company risk can be reduced by researching the company's fundamentals, such as its financials, products, customers, and competitors. Inflation risk is the risk of losing money due to the decrease in the purchasing power of money over time. Inflation risk can be caused by various factors, such as monetary policy, fiscal policy, or supply and demand. Inflation risk can be reduced by investing in stocks that can grow faster than the inflation rate, such as growth stocks or value stocks. Stocks may also offer dividends, voting rights, and legal protection to investors. Dividends are the payments that companies make to their shareholders from their profits. Dividends can provide a steady income and a reward for investing in the company. Cryptocurrencies, on the other hand, are subject to liquidity risk, security risk, and regulatory risk, but they may also offer anonymity, decentralization, and innovation. Liquidity risk can be caused by various factors such as low volume, high volatility, or limited access. Liquidity risk can be reduced by investing in cryptocurrencies that have high volume, low volatility, and wide access, such as Bitcoin or Ethereum. Security risk is the risk of losing money due to the theft or loss of an asset. Security risk can be caused by various factors such as hacking, phishing, or human error. Security risk can be reduced by using secure and reputable platforms, wallets, and exchanges, and by following the best practices of cybersecurity, such as using strong passwords, encryption, and backups. Regulatory risk is the risk of losing money due to the changes or restrictions in the rules and regulations that govern the crypto market. Regulatory risk can be caused by various factors such as bans, taxes, or compliance. Regulatory risk can be reduced by staying informed and updated on the legal status and implications of cryptocurrencies in different jurisdictions and scenarios. Cryptocurrencies may also offer anonymity, decentralization, and innovation to investors. Anonymity is the ability to transact without revealing your identity or personal information. Anonymity can provide privacy and security to investors and users. Decentralization is the ability to operate without relying on a central authority or intermediary. Decentralization can provide autonomy and efficiency to investors and users. Innovation is the ability to create and use new and improved technologies and applications. innovation can provide opportunities and benefits to investors and users. To conclude, stocks and cryptocurrencies are two different types of investments that have their own advantages and disadvantages. Stocks are more stable and regulated, but they also face market, company, and inflation risks. Cryptocurrencies are more volatile and unregulated, but they also offer anonymity, decentralization, and innovation. Thank you for watching this video, and if you enjoyed it, please like, share, and subscribe. And let me know in the comments below, what do you think about stocks and cryptocurrencies? Which one do you prefer and why? I'll see you in the next video. Bye for now.